Good morning, everybody, and welcome to this, another of our Dafferns Wealth webinar series. This morning, we're going to be talking about investing in a COVID-19 world. The COVID-19 crisis is not going away. We have the new English lockdown starting later this week, creating more and more uncertainty, making investing in this unpredictable COVID world all the more challenging. Firstly, Dafferns Wealth provide independent financial advice. Dafferns Wealth is an appointed representative of Insight Financial Associates Limited, which is authorised and regulated by the Financial Conduct Authority. And Dafferns Wealth provide investment, pensions, protection, independent financial advice. And we've been working with our main presenter this morning, Steve Wheatcroft, for well over 10 years. And Steve's got a huge amount of experience over many, many years advising individuals and businesses on all aspects of pensions, investments and protection. And our other independent financial advisor is Rachel Lega, who we've been working with for just over a year now. And Rachel has a huge amount of experience as well, particularly on the private client side, retirement planning, inheritance tax planning. So the first part of today's presentation is with Steve. So I'll hand over to Steve.
Thank you, Martin, and good morning. So we just want to have a look at really what's going on in the world, how COVID-19 is affecting markets, but also the wider investment proposition at the moment, because long before COVID-19 came in, we were facing quite a few challenges on the investment side because of many issues, low interest rate being probably the main one. And so I'm going to go through some background to COVID-19, and then Rachel and I will run through some of the options that we're recommending at the moment, being smooth funds. Rachel will cover managed portfolios. Then I'll look at tax efficient options on the basis that if the tax man is going to help contribute towards your investment, why not? And Rachel will finish with structured products and a bit on cash flow planning. Obviously, things are a bit strange at the moment. COVID-19 is affecting so much of our lives. And of course, the goalpost moved yet again over the weekend, which is not going to help us on the investment side. But long before COVID, we were looking at an investment world where inflation has been low for quite a while now. And whilst there might be a little bit of pressure on inflation going forward, it's likely to stay low for a while. So if we're nervous about stock markets and equities generally, the other sort of mainstays of the investment world also have their challenges. So, for example, property has been through a difficult time. Now, obviously, retail has been through a really bad time, particularly on the high street. But of course, one of the implications of COVID is that we might even see pressure on the office sector, because a lot of people have worked out that they don't need to be in an office to carry on working. And cash, because interest rates are so low, is giving very poor returns. The base rate's down at 0.25, so that with inflation running at around 2%, holding cash sort of guarantees that you're going to lose money. And then the other mainstay that traditionally that we've used in the investment world is the fixed interest market. Government securities, gilts, corporate bonds, again facing lots of challenges, and it's actually very difficult to see any sort of real return at the moment. So where do we go? Stock market, which had been comfortably over 7,000 before COVID, took a big hit in February and March, drifted down towards 5,000 points on the FTSE 100, recovered to some extent to over 6,000, but the last week or so has dragged it down again. So this morning we're at around 5,500 points. So where do we go? Is there any good news? Governments are obviously doing their best to try and keep a lid on the problems that the economies are facing. Central banks are doing the same, releasing money, trying to keep finances in shape. And behind that, the banks are actually in a much better shape than they were back in 2008 when we had the banking crisis, when the problems we had then with the stock market were compounded by the fact that the banks really struggled to keep going, and without government support, a couple of our banks would have gone under. The furlough schemes have made a huge difference. It's at least enabled people to keep their jobs in some form, and of course it's now been extended again for another month. The next point probably doesn't has changed a bit, because the economy was opening up with easing out to help the economy and all that sort of stuff, now being put very much on hold for the next month. And of course, as far as COVID is concerned, the medical world is getting better at understanding what it's all about and treating it. And governments are doing all they can, for example, to get stocks of vaccine in place when it's available. So there are some positive signs, but it's going to be a very difficult few months. Now, who would have guessed that anybody could come up with some figures for the last 5,000 years? I don't know who did this, but basically over 5,000 years, interest rates have traditionally been a lot higher than they are now. You sort of follow this weird graph through the 1800s, and you get to 1930, you get the Great Depression, and that was a time of quite low interest rates as markets struggled. Then you come through to the 70s and 80s when inflation and interest rates were very high. Those of us with mortgages at that time will remember it well. But actually where we are now in terms of the long-term prospect for interest rates is lower than it has been in 5,000 years. A bit of information on the extent to which various governments have done their best to try and support their economies through this. Probably not too surprising to see that in terms of the proportion of GDP that's been thrown at the problem, Germany have spent the most with 60% of GDP. Don't know how Italy managed to fund 44%, but they did. We're there at 21%, so still a massive amount of stimulus for the economy provided by the government. Perhaps a bit surprising that the States is lower at 14%, but you can see much of their investment has been in the form of immediate fiscal stimulus. What this graph is saying is that actually, in terms of the traditional investment options, property, fixed interest, cash, there's really no great value. And what this means is that the only traditional investment option that looks to offer any sort of value at the moment is actually stock markets, equities. In terms of value for money, they look very strong at the moment. But of course, that comes with risk, because the investment in markets means volatility, and a lot of clients just aren't comfortable with that sort of volatility. And it's all about finding a compromise that we're comfortable recommending that I think works for most people who take a sort of medium risk approach to how they want their money invested. And what we'll see, I think, well, it's been announced, as we come out of this, is really a lot of investment in infrastructure, which is probably going to help the economy in itself. The Prime Minister saying he'll build 40 new hospitals. One of the implications is that we're probably going to see a drive towards greener energy and investment in that sector. What seems to be clear is that 10 years of austerity is history. There's no way that we can be saving money at the moment. It's got to be a question of spending to support the economy. Although clearly the extent to which the government's able to do that will depend how much is available once we've got through COVID-19, because it's proving to be a little bit expensive. Against that background, let's just think about some options that perhaps work in this rather strange world. And I'm going to start off with what we call smoothed funds. And this has been a major market for quite a while for us now. And this is basically about fund managers, normally in the form of insurance company managers, who want to offer an investment medium which protects investors to some extent from the extremes of market volatility. So it's all about creating a band of return, which hopefully doesn't offer the extremes that you would normally see from stock market investment. Now, the biggest player in this market is Prudential. We've been using them extensively for a long time. We've put millions and millions of pounds of client money in there. And what they want to do is provide a smooth return based upon a long-term investment model. Prudential invests about 500 plus billion pounds. They're massive investment players. And that gives them the ability to do things that a lot of other companies can't. But they actually run a 10 to 15 year model, which sort of sounds sort of very simple, but it's not. It's a really complex vehicle that they use to determine what sort of returns they expect this fund to achieve over 10 to 15 years. And based upon that model, they think they can achieve, for example, at the moment, just under 5% over the long term for investors, less of all their charges. And therefore, that's what they pay. On a quarterly basis, they announce what the rate will be. It doesn't change very much. It doesn't change very often. And as long as markets perform within certain parameters, then that's what they'll pay. It's all about protecting clients from short-term volatility. It can't deal with extremes. So, for example, in 2008, when we had the banking crisis, they did have to put an adjustment on the value through. We saw a reduction in the face value of the fund. But actually, within 12 to 18 months, the model took over again, and they were back to the long-term returns that they expect to achieve. And the same thing has happened this time around. So that in February, they did have to apply a negative adjustment to the fund. But we've already seen some recovery. They've added 3% of that back in. But the bottom line is that in most circumstances, they will go with this expected growth rate. So that if you have money in the fund, on a daily basis, it will grow at that rate. It will grow on a daily basis. It will be added on a daily basis. The money is accessible without penalty immediately. So it's very flexible in that sense. Yes, bear in mind that there will be these occasional unit price adjustments in extreme times, but they're quite rare. And what it does give is a degree of stability for the investor. And they're actually available through a lot of different mediums. So we can access this fund through ISAs. We can access it through pensions, but also as what we call a capital investment bond, or even through offshore funds where it's appropriate. And I'll make the point a couple of times that because returns from cash is so poor, using this fund as an ISA, as an alternative to cash, looks very attractive for a controlled level of risk that goes with it. So that's one option. Rachel will now take over.
Thanks, Steve. So in terms of an alternative to the smoothed funds that Steve just talked about, some people do actually want to, they're happy to have the volatility that perhaps a more traditional fund would have, but the watchword for successful investing over the longer term is diversification, or not having all your eggs in one basket. Now, 10 years ago, 10, 15 years ago, if myself and Steve had sat down with a client looking at the pension or their investments, we'd have had to have sort of sat down and pored over fund fact sheets and done lots of research to try and pull together a portfolio, which may have stayed exactly the same, till the next year that we see a client or whatever time period that may be. But of course, things move much more quickly now. So over that period, we've had the evolution of the discretionary fund manager. And they are essentially doing what myself and Steve might have done, but far more effectively, I would say, with far more research and also focusing on the idea of risk. Now, if we can just sort of have a quick look at the idea of risk, Sophie, what a discretionary fund manager does is their focus is, as I say, diversification and risk. So they are going to be initially looking at where in the world do we invest for an investor? What is potentially going to give us the best returns at this time? But then they're also looking at the idea of volatility. Steve's already mentioned the fact that things go up and down. And somebody who is prepared to take a lot more risk is invariably happy to take a lot more sort of the volatility. And if we can just whiz back, Sophie, sorry, I waved my hands at an inappropriate time. If we can just go back, what you can see here is an example of one of the discretionary fund managers and their current range of portfolios. So they will have a portfolio based on the level of risk that an individual wants to take. And you can see here, we've got portfolios for somebody who might take a more defensive approach, moving right through to somebody who would take more of an adventurous approach. This individual discretionary fund manager also has an income-based portfolio as well. But what you can see here is the different proportions that they hold of the asset classes. So a defensive, a very low risk investment would have a high proportion of the fixed interest securities, the bonds that Steve mentioned. Whereas if we then whiz over up to the high risk, a much lower proportion of this less volatile investment, but a heavier focus on equities. So they are controlling risk, and every day they're reviewing what assets they're holding and in a very simple compliance-based way. Now, if we can have just a quick look at the performance, how does this translate? What they're actually doing is, again, these are actual performance figures for one of the discretionary fund managers. And you can see that the old adage of the more risk that you take over the longer period, the more returns you should have. But in doing that, you may have had a very bumpy ride. But here you can see the performance of the defensive portfolios moving through to the adventurous. And by and large, that higher level of risk, that has been rewarded. We've got a slight anomaly here in the year's performance where this balanced portfolio has done very nicely compared to the next level of risk up with the growth portfolio. But that's not sort of a common thing that we would expect to see. But a discretionary fund manager is a really good way of getting this diversification that we all need, which is constantly being reviewed by professionals who are sitting down with individual fund managers to actually give us a portfolio that is risk-based and hopefully maximising the returns given current market conditions. Thanks, Steve.
Thanks, Rachel. So now I just want to cover off a few options which give us a tax break. Because at the end of the day, if the taxman is effectively contributing towards your return, that's probably quite attractive. I'll take a very quick run through ISAs, pensions, and then look at an enterprise investment scheme, venture capital trust, and then business property relief schemes. So ISAs, some of you may be old enough to know that they've been around in one form or another for nearly 40 years. Margaret Thatcher introduced personal equity plans back in the 80s, which evolved into ISAs. And basically, people who've been in a position to take advantage of them over the long term have managed to put together quite substantial funds, which effectively now sit in a medium that's free of both income tax and capital gains tax. There's plenty of people with well over £1 million sitting in ISAs in one form or another. So that's quite attractive. As well as the tax-free return, they're quite flexible. There is an ISA transfer option on any scheme, so that if you're in an ISA that isn't performing very well, Sophie, can we just run on to the next one? You can move between ISAs without losing the tax effectiveness. And as I've said already, cash ISAs, a lot of people sitting on cash ISAs, lots of money, earning maybe 0.25%. It's really worth just having a look at what are the other options available, because you can easily move them into a median or to another ISA, giving a better return, albeit with maybe a slightly higher risk profile. But in principle, you have a significant allowance each year, and it really is worth looking at taking advantage of that if you can. So going on to pensions, obviously a mainstay of financial planning for many, many years. Successive governments have really wanted to encourage people to put money into pensions, create some independence for themselves in later life. And so we've long had a regime where there's tax relief on contributions, so the government's paying part of your contribution. and once invested, the funds are allowed to grow completely tax-free. Well, I say completely, Gordon Brown attacked the tax on dividends, but never mind, but broadly tax-free. So it's a way of building up a significant pot of money to give you security in later life, and actually in a form which some people now see as a family trust, a sum of money that they may not use in their own lifetimes that they can pass down to their children, and there are actually quite attractive death benefit options, so that we never recommend clients die before the age of 75, but if they do, the benefits, the pension fund passes on completely free of inheritance tax. Beyond 75, there is a potential tax charge, but it can still pass on tax-free in the form of a pension for their children. There are limits. There's an annual limit to what you can put in. There's a lifetime limit on what you can have in pensions. And of course, apart from tax-free cash, you have to bear in mind that when you do take money out at the other end, I'm afraid that at that point it is taxable income. But still a massive weapon that we use in the investment world and can be very effective. And it can also be a really useful business tool. So many businesses have used their pension funds over the years to fund purchase of their premises, for example. It can be positive in so many ways. But let's just look at some more straightforward and probably more tax efficient, short-term tax efficient options. And the first one is the Enterprise Investment Scheme. It's actually been around for nearly 40 years. 1993 it came into being, and since then a scheme which was effectively set up to make it easier for small businesses to raise funds has helped about 26,000 companies, and they've raised through that over £16 billion. So it's actually become quite successful. And of course it works because investors who are prepared to put money in to help fund small businesses get some pretty good tax benefits. The first of which is 30% income tax relief. And you can actually invest £1 million a year if you have it, or you pay tax on that much, and get 30% back, which is quite attractive. And also, once you've held the investment for 3 years, it's going to be exempt from capital gains tax. So if the business you've invested in is successful, you'll get a tax-free return. If it isn't successful and it loses money, well, you can claim loss relief on it. But I think the key to this is risk, because when it came into being, it was all about creating funding for small and often new businesses. And of course, that really means quite a high level of risk. But the market's developed to the point where we have managed options. We have specialist fund managers who source the companies to invest in, do a lot of research and cherry pick the ones that they think are more likely to be successful. So that takes away a lot of that risk associated with these schemes. So by using managed options, by taking advantage of the tax relief, I think it becomes quite attractive. Why wouldn't you invest in something that where the taxman's giving you such a healthy contribution towards that investment? And then going on to venture capital trusts, similar in a way, but again, it's all about raising funds for investment in smaller businesses. Again, 30% tax relief on investments up to 200,000 each year. And again, any income or growth that comes out at the other end when the business is successfully sold is free of income tax and capital gains tax. So it actually works as time passes in that it offers a strong dividend return. So what we tend to see from venture capital trusts is a dividend stream coming through. And of course, if that's tax-free, that's quite attractive. In 2018-19, £294 million was generated by venture capital trusts as tax-free dividend for investors. So quite attractive. And again, as with EIS, these days, rather than trying to find a fund to invest in yourself, most money goes through specialist managers who do all the research, the vetting. Some of you may remember a very old advert for John West Salmon, which talked about it being the fish that John West rejects that make it such a good product. Well, it's similar, because the vast majority of applications by companies looking for investment are turned down. The managers really are able to filter down and hopefully find homes for your money that have pretty good prospects. And then finally, as far as I'm concerned, we'll look at business property relief. These are really all about inheritance tax. Inheritance tax is very simple. If you've got enough money, then on death, you'll pay a straight 40% of your estate to the taxman. And you might be very comfortable with that. You might prefer to look at options to alleviate that. And this is one of those, because basically, if you invest money in a company that qualifies for business property relief, then once you've held that asset for 2 years, it's completely free from inheritance tax on death. So it's a huge saving. There is a rollover relief option, and for me, this is quite significant. There's a lot of people who are business owners who go through life, or their business lives at least, confident that they don't really have an inheritance tax problem because their business is free from inheritance tax. And so they wouldn't lose much sleep about it. But as soon as they sell that business and convert the business to cash, then overnight they've got a huge sum of money which is now subject to inheritance tax. Well, actually, in those circumstances, you can immediately roll over into one of these schemes. You don't have to wait the 2 years for it to qualify.
So far we've looked at different ways of investing with smooth returns, discretionary fund managers. We've looked at the tax wrappers that Steve's just gone through. But we thought, obviously, diversification being a bit of a watchword, that there are times when we discuss with clients something called structured products. Now, this may be something that you've heard of, it may not be. But essentially, what a structured product is, it can be quite useful as part of an overall portfolio. And as you'll see here from the screen, they are fixed term investments. So typically anything from 3 to 5 years. And there is a predetermined level of growth that you'll be aware of when you start these investments. Whether you achieve that predetermined level of growth will depend largely on whether the actual investment has performed in a certain way. Now, usually these investments are linked to something, as the screen says, the FTSE 100, whereby when you start the investment, they'll measure the FTSE. And then when you finish the investment, typically, or at various points along the way, they'll say, right, is the FTSE 100 higher than its starting point? And if it is, then you've achieved what is required to get your return. Now, there are 2 different types of structured products. There's what we call a deposit structure, which is where actually the capital that you put in is protected. The other type is an investment structured product, where actually the capital you put in is not protected and can be at risk of going down. But these are quite useful sometimes to use because of this idea of a predetermined level of growth that you may achieve. Worst case scenario, with the investment structured products, you may actually lose some of that capital, but they can form part of a portfolio. So just moving on, 2 examples for you. Typically, what happens with the structured product is they're brought out in terms of tranches. So you will have a provider that will sort of bring out an investment for a period of perhaps 6 to 8 weeks, and then it will be removed and a new product will come out. Now, a current product that is out at the moment, just to give you a quick flavour, is a project provided by Investec and is giving us 6.85% return. Now, there is, of course, an element of risk here. So you're actually weighing up, well, is that potential return worth the risk of actually possibly in the future losing some of the capital I put in? So that's a conversation, but it may have its place. Now, a reasonably new development is that there are now some fund managers who are, if you like, almost producing a fund of structured products, to put it very, very simply. We've got an example here, and there are other fund managers with Atlantic House Investments who've got a fund doing this, and they're aiming to provide sort of 7 to 8%. Now, just to give you a quick view of how this may or may not sort of turn out, they've got the latest fund fact sheet, which we're looking at here, and just moving down, what we're going to just cast our eye over very quickly is the, here we go, the discrete annual performance. So you can see that actually in any year's performance, we've not hit sort of 7 or 8%, and on some occasions it's been substantially higher, and some occasions it's been substantially lower. But that is their target return. But the important thing, I think, with the idea of this fund is a potential downside of structured products is the fact that they're time bound. Whereas actually this idea of a fund means that you're not stuck to sort of a 6-year product. We've looked at quite a range of different investments. It is a weird time. And as Steve has sort of said, you can't make money in cash. We've got volatility in other areas. Property has sort of come under question. So it is really difficult to find where you can put your money. And obviously that is something that we will spend time going with you to help you achieve that. But the important question is perhaps not how have your investments performed, but is rather more, how has the performance of my investments affected my future plans? Because why do we invest money? Well, it is for our future. It's typically for a future event. And how is that going to be affected? So what myself and Steve can do is help you to understand, actually, if your investments have gone down, how does that impact your future? We can do this idea of cash flow planning and modelling, which, just to give you a very, very brief overview, enables us to pull together all of your information. So here, and hopefully this will be fluid and you'll be able to see, we can collect together. We've got an example here of a couple of clients. We're pulling in together their salaries, what they earn, what have they got in terms of pension provision. We capture all of that, and we can make some assumptions about growth. But one of the important things here is that as we review your investments, we can, reduce the balance. What impact does that have? Does it have if actually your investments have gone down by 10%? Does it affect your future plans? And just to give you a feel for what this overall outlook might look like, we're able to tell you whether actually you're going to run out of money in the future. And this lovely green line here tells us that this example couple here won't run out of money. It also tells us whether our income plans are going to cover our outgoings. And in this case here, for this couple, where the blue lines are, that is income which is sufficiently covering outgoings. Little spike here, we've got one of them retiring, so we've got some tax-free cash coming into play. But thereafter, once retired, we've got reduced income. So actually the green here is representing dipping into other investments that you might hold. And we can look at that impact on the net worth of the client. And Steve's mentioned inheritance tax, various other things. That helps us identify whether you have got a future inheritance tax problem or that there might be other issues sort of coming into play. So this helps when we're reviewing clients' portfolios, because it is very, very easy in these times when things are very uncertain to actually focus on the negatives. But the important thing is, if possible, is to sort of try and pull that back round to say, well, how is that actually going to affect my future? And in doing that, me and Steve will help you find the most tax efficient way of doing it and do our absolute best to make sure that you're maximising the returns based on the level of risk that you are able to take.
Thank you very much, Rachel and Steve. Yes. Now we've got a little bit of time left for questions, and I know one of our participants raised a question about wealth tax and the possibility of wealth tax. So I'm going to ask Brian King, who's Dafferns' private client partner, if he'd like to come in. I've just turned your microphone on, Brian.
Yeah, so the question asked whether there would be an introduction of wealth tax. I've seen in the newspapers talk about inheritance tax increasing, or there may be a wealth tax which could be applied as a one-off charge or an annual charge. But the way I view that at the moment is just a sort of speculation within the press. But one thing that I'm definitely aware of that is happening is that there is a review to sort of simplify capital gains tax. Now, at the moment, capital gains tax is paid at either 10%, 18%, 20%, or 28%, depending on the nature of the asset sold and the income position of the individual. So there is a whole range of complex rates and assets before you can quantify a capital gain. And what is being speculated there is that capital gains tax could be aligned with the income tax rates at some future point in time, which it does carry some mileage.
I think you're quite right there, Brian. It's what you make about the overall impact of capital gains tax not being a huge source of revenue for the government. And yeah, at some point, some taxes have got to go up. Entrepreneurs relief is a big thing for many of our clients, where they can effectively limit their capital gain on disposal of qualifying shares in a qualifying business to currently 10% of the first a lifetime £1 million. I haven't seen anything specifically recently about that disappearing. Do you have a thought on that, Brian?
No, I haven't. It was reduced from £10 million to £1 million. £1 million still may be the incentive for people to be entrepreneurs and create businesses. But what may happen is that if capital gains tax and income tax rates are aligned, it could well be that any gain after £1 million may be taxed at income tax rates.
Brilliant. Okay. We are just about there. We were planning on running for 45 minutes. I think we have a minute to go. Steve and Rachel, do you have any final wrap-up comments you'd like to make? Steve first.
Just on that question, I agree. Personally, I'd be surprised if we saw any sort of wealth tax, but there's no getting away from the fact that there is going to be a big deficit when we get out of this. The government will be looking at ways of recovering it in some form. The message from today is don't be too negative about where we are financially. It's going to be a difficult few months in many ways, but there are ways through this, and we can help.
Rachel?
Yeah, I think as you look through history, and we are undoubtedly in a unique period, but there has always been something at some point in history that has made us feel dreadful, worried, concerned. And really, it's more of a question of when do we come out of it rather than, are we going to take the advice as we go along, and we will do our best to support.
Thank you, Rachel. Well, calling today's webinar to a close, if anybody has any questions, please feel free to get in touch. All of the people on the webinar today, Steve, Rachel and Brian King, all contact details are on the Dafferns website, dafferns.com. We look forward to seeing you on our next Dafferns Wealth webinar. Thank you very much.